What happens when a multi-million-dollar mining company just stops blaming the rainy season for missing its production targets?
Right, because that's like the classic excuse in this industry.
Exactly. They stop making excuses and they just go out and buy a massive industrial dryer. Well, I'll tell you exactly what happens. You get a 170% explosion in gold production.
It's a completely wild number to see on an earnings report, honestly.
It really is. So welcome to this special Talk Tickers Deep Dive. You are here because, well, you want the signal cutting through the absolute noise of corporate earnings.
Yeah, there's just so much noise out there.
So much. And you want the critical takeaways translated out of, Wall Street jargon so you can actually use them to make informed decisions. We look at the data, we figure out what it means, and we tell you how it impacts your portfolio.
That's the mission.
Today, our deep dive is laser focused on Ero Copper. That is ticker symbol ERO. And specifically, we're unpacking the absolute granular details of their second quarter 2026 earnings call.
And, you touched on the key theme right away with that industrial dryer.
Yeah.
When we analyze corporate earnings, especially in the resource sector, there's this pervasive temptation to just look at the global price of a commodity, right? Look at the company's revenue and draw a straight, lazy line between the two.
Like copper goes up, stock goes up. Simple as that.
Exactly. People think the macroeconomic winds blow and the company either sails or sinks. But what we're analyzing today is, it's a masterclass in the absolute minutia of operational control.
We are getting into the dirt today. Literally, we're going to look at the headline numbers to see if they're actually making money.
Which is step one, always.
Right. Then we're going to explore the physical reality behind those numbers, the logistics, the physics, the actual mechanics of how they're operating.
The stuff that actually moves the needle.
Exactly. Then we'll pressure test management's guidance for the future. And finally, we'll boil it all down to the bottom line for you, the retail investor holding or watching this stock. No fluff. Just the data and the mechanics behind it.
Sounds like a plan.
So let's start right at the top of the income statement. Because before we care about how they optimized a mining plant, we really need to know if the cash register is actually ringing.
Yeah, the top line vital signs are the foundation of any corporate analysis. So for the second quarter of 2026, Ero Copper reported revenue of $284.3 million.
Okay, $284 million.
Right. And that represents an 8% increase sequentially from the first quarter. But as any seasoned investor knows, revenue is just top line vanity.
Yeah, it looks good on a press release.
But it tells you the total volume of money coming through the door, and it tells you absolutely nothing about how much it costs the company to generate that money.
Right. If it costs you $300 million to make $284 million, you aren't running a business. You're running a charity for your suppliers.
Exactly. Which brings us to the adjusted EBITDA.
Okay, let's unpack that for a second. EBITDA.
Yeah, so EBITDA stands for earnings before interest, taxes, depreciation, and amortization. In the mining sector, this is like the most crucial metric for measuring pure operational profitability.
Because mining is just incredibly capital intensive.
Oh, massively. You buy these massive trucks, you build processing plants, and the accounting rules require you to depreciate those assets over time.
Right, which drags down your net income on paper, even if you aren't actually spending that cash today.
Exactly. So adjusted EBITDA strips out all that accounting noise. It tells us basically from the pure act of pulling rock out of the ground and selling it, how much operating profit did you actually make?
Okay, and the number here is substantial. Adjusted EBITDA hit $144 million for the quarter.
Which is huge.
It is. That's up significantly from $125.2 million in the first quarter of 2026.
We really need to put that margin into perspective, though. Generating $144 million of operational profit on $284 million of revenue.
That's what, about 50%?
Yeah, it means their EBITDA margin is sitting right around 50% in heavy industry. A 50% margin is spectacular.
Right.
It means that for every dollar of copper or gold they sell, half of it is pure operational profit before dealing with debt and taxes.
That's incredible. And that brings us to the actual cash flow. Operating cash flow, so the literal cash hitting their bank accounts from running the business, came in at $137.9 million.
A massive jump.
I really want to emphasize the scale of this for you. That is a sequential increase of approximately 49% quarter over quarter.
Nearly 50%.
A nearly 50% jump in cash generation in a single 3-month period. When I see a number like that, my immediate question is like, what's the capital allocation strategy? What are they doing with a $138 million cash injection?
Well, They are aggressively, almost relentlessly, really attacking their debt. And this is where the narrative of this company begins to shift dramatically.
Okay, I love a good balance sheet cleanup. Let's talk about it.
We need to look at their net debt leverage ratio. This is a metric Wall Street uses to determine how dangerous a company's debt load is.
How exactly does it measure that?
It essentially measures how many years it would take the company to pay off all its debt if its EBITDA remained perfectly flat.
Okay, got it.
So at the start of 2025, Ero Copper's net debt leverage ratio peaked at 2.6x.
Okay, let's pause right there and translate that 2.6x ratio. Because a number in a vacuum doesn't mean much to most people.
Sure.
If I'm holding this stock at the beginning of 2025, how suffocating is a 2.6x leverage ratio in the mining industry? Is that a panic number?
It is highly restrictive because you have to remember mining is a cyclical industry. The price of your product is dictated by global commodity markets that you have absolutely zero control over.
Right, you're at the mercy of the market.
Exactly. So carrying a 2.6x debt load means a massive portion of your future cash flow is spoken for. You are essentially working for the banks.
Right, so if copper drops...
If global copper prices take a sudden dip, your EBITDA shrinks, but your debt obligations stay exactly the same. So suddenly that 2.6x ratio inflates to 3.5x or 4x.
Oh, wow. And then you're in real trouble.
Yeah, you risk breaching debt covenants, and the market brutally punishes your stock price. It limits your ability to invest in new projects, it kills any hope of a dividend, and it just forces management into this defensive survival mindset.
It's literally the corporate equivalent of living paycheck to paycheck.
Yeah.
But the paycheck is completely dependent on whether the global economy decides it needs more copper wiring this month.
That captures the precarity perfectly. But look at where they are now. In this Q2 2026 report, that leverage ratio has plummeted to 0.8x.
That is a massive drop.
They have functionally removed the existential debt threat from the balance sheet.
And they're doing it through direct, aggressive payments. I mean, they have paid down $60 million of their revolving credit facility so far this year alone. That actually includes a $25 million payment they pushed through in July, so immediately after the quarter closed. They aren't hoarding this cash. They are actively destroying debt.
Dropping from 2.6x to 0.8x, it fundamentally changes the psychology of the boardroom.
How so?
Well, below 1.0x, a mining company gains structural resilience. They're no longer operating in survival mode, They have the financial breathing room to make long-term operational investments.
They can weather unexpected downturns.
Exactly. And critically, they can begin planning how to return capital to you, the shareholder.
But I have to play devil's advocate here for a minute.
Bring it on.
I look at these massive jumps, right? A 49% increase in cash flow, revenue climbing to $284 million. And my instinct is to look at the global markets. Copper prices have been strong. Gold is trading at historic highs.
Yes, very true.
So if I'm a retail investor, I really have to ask, did management actually do anything to earn this? Or did they just happen to have their buckets out when the macroeconomic weather decided to rain gold and copper? Were we just praising them for a lucky break?
Mm-hmm. That is, honestly, the most important question to ask when analyzing any resource company. Is this structural alpha or just macro beta?
Exactly. Are they smart or just lucky?
Right. And the reality is that commodity price tailwinds certainly provided a lift. CEO Mako DeFilippo acknowledged that. He said higher copper prices and strong gold sales volumes were primary drivers.
So there was some luck involved.
Yes. However, we have to look at the mechanics of how that revenue flowed through the business. If it were purely macroeconomic luck, we would see a revenue increase, but we would likely see costs increase right alongside it due to inflation, which mutes the actual cash flow.
Which happens all the time in mining. The price of copper goes up, but suddenly diesel fuel, steel, and labor all skyrocket. So the actual profit margin just stays stagnant.
Exactly. But that isn't what happened here. DeFilippo used a very specific, very deliberate phrase on the earnings call. He stated that this quarter represents a fundamental cash inflection for the business.
Cash inflection. I mean, that sounds like a carefully workshopped piece of investor relations phrasing. What does it actually mean operationally?
An inflection point implies a permanent change in the trajectory of a curve.
Okay, yeah.
What he's signaling to the market is that the structural changes they've made over the last 18 months have permanently altered the company's cash generation profile.
So it's not just a temporary bump.
Right. They didn't just passively collect higher commodity prices. They fundamentally re-engineered their cost structure and debt profile so that a significantly larger percentage of every dollar earned actually survives the income statement and lands in the bank account.
Ah, I see. So the rising tide lifted the boat, but management spent the last year patching the holes in the hull and upgrading the engine.
That is exactly the dynamic. DeFilippo even emphasized, quote, "The cash inflection of our business, it's clear that it's already happened," end quote.
So it's not some projection for next year.
No, he isn't selling Wall Street on a future promise. He's pointing to the rearview mirror and saying, the structural shift is complete. The cash is here.
Okay, well, if management is claiming they patched the hull, we need to go down into the engine room and verify it. High revenue is a great headline, but the spreadsheet is just a mathematical reflection of physical actions happening in the real world.
Right, the numbers come from somewhere.
Exactly. So let's leave the corporate accounting suite and look at the actual operations.
We really have to understand the mechanics of cost reduction because that is where the margin expansion actually occurred. Let's examine this initiative they're calling OneEro.
Right, OneEro. I read the transcript on this, and honestly, OneEro sets off all my corporate jargon alarms.
I don't blame you.
It's defined as a, quote, company-wide strategic program designed to enhance operational efficiency, streamline procurement, and unlock cost synergies. Synergies. It sounds like a consultant charged them $5 million to come up with a slogan.
It absolutely carries the flavor of a corporate buzzword. I get it. But as an analyst, you have to ignore the branding and look at the underlying mechanics.
Okay, so what are the mechanics?
When a company operates multiple mine sites, so in Ero's case, the Caraiba operations, the Tucuma operations, and the Xavantina gold mine, those sites often develop their own isolated cultures.
Right.
They operate as fiefdoms. So the Caraiba procurement manager is out buying truck tires from one vendor, while the Tucuma manager is buying the exact same tires from a different vendor at a completely different price.
And they're probably competing against each other for the same contractors, too.
Precisely. What the OneEro initiative actually represents is the forceful breaking down of those silos. DeFilippo detailed that they overhauled leadership on site to change the collaborative culture.
Okay.
But more importantly, they implemented centralized data analytics across all their operations.
Okay, wait, how does data analytics actually strip cost out of pulling rock out of the ground? Walk me through the mechanism of that.
Imagine having thousands of data points on supply consumption, right? Diesel fuel, explosives, grinding media, vehicle parts. By centralizing that data, the corporate office can suddenly see the aggregate demand across the entire company. So they can walk into a supplier's office and say, look, we aren't just buying for Caraiba anymore. We are negotiating a single unified contract for our entire Brazilian footprint.
They have actual leverage now.
Exactly. Give us your absolute best volume discount or we take the entire portfolio elsewhere.
Oh, that's brilliant. It's the Costco model of mining procurement. You buy in massive bulk, force the supplier to compress their margins, and you capture the difference.
And the results of that leverage are highly measurable. Management confirmed that this initiative alone successfully stripped between $10 million and $15 million in annualized supply contract savings out of their operating costs.
Wow.
That is cold, hard cash that no longer leaves the company.
That is a very solid win for procurement. But there's a much bigger cost-saving measure that Executive Vice President and CFO Wayne Dreyer detailed, and this requires us to really understand the macro mining landscape.
Yes, the smelting contracts.
Right. He announced that they renegotiated their smelting and refining contracts, which is expected to net them $20 million in savings for 2026 alone.
This is perhaps the most misunderstood aspect of the copper mining industry for retail investors. The general assumption is that a company like Ero just digs pure, shiny copper out of the ground, stamps it into a brick, and sells it on the open market.
Right. You picture a guy with a pickaxe finding a solid chunk of copper wire.
But the physical reality is vastly different. What Ero Copper actually produces at its mine sites is a concentrate. They crush the ore, run it through chemical flotation circuits, and produce this powder that is roughly 30 to 40% copper.
Okay.
But you cannot use concentrate to build an electric vehicle or wire a house. That concentrate must be physically shipped to a specialized industrial facility called a smelter.
Right. And the smelter uses extreme heat and chemical processes to separate the impurities and produce that 99.9% pure copper.
Exactly, the copper cathodes.
And those smelters do not work for free.
They certainly do not. Smelters charge the mining companies fees known as treatment charges and refining charges. These are universally referred to in the industry as TCRCs.
TCRCs, okay.
And these charges are the central battleground of profit margins between miners and smelters.
So how did Ero magically wring $20 million of savings out of these smelters? Did they just ask nicely?
Not quite. They capitalized on a massive structural bottleneck in the global copper supply chain.
What's the bottleneck?
Right now, there is a severe shortage of raw copper concentrate globally. Existing mines are aging, new discoveries are rare, and permitting takes decades. However, over the past few years, countries like China have aggressively built out massive new smelting capacity.
So you have a situation where there are too many smelters starving for material and not enough mines producing the concentrate.
Exactly. The leverage has completely shifted from the smelters to the miners. Smelters are desperate for concentrate to keep their furnaces running.
Because shutting down a massive industrial furnace is catastrophically expensive, right?
It's incredibly expensive to cool them down and fire them back up. Therefore, the smelters are forced to aggressively slash their treatment and refining charges to attract whatever concentrate is actually available on the market.
Okay, but Ero isn't selling their concentrate on the spot market day by day. They sell on long-term contracts, right?
Yes, term contracts. This means their TCRC rates were locked in years ago, likely when the market dynamics favored the smelters.
So how did they get out of them?
What CFO Wayne Dreyer accomplished was purely a matter of timing and leverage. As several of their historical, expensive term contracts naturally expired, Ero's management stepped into the renegotiation room holding all the cards.
Because the smelters needed them more than they needed the smelters.
Exactly. They leveraged the global smelter desperation to lock in radically lower TCRC rates for their new contracts.
And because the cost of pulling the rock out of the ground hasn't changed, every single dollar they save on those smelting fees flows uninterrupted to the bottom line.
Pure profit.
$20 million in pure margin expansion that has absolutely nothing to do with whether the global price of copper goes up or down. It's just brilliant structural positioning.
It is a textbook example of a management team exploiting macroeconomic bottlenecks to generate microeconomic cash flow.
So we have 15 million saved on supplies, 20 million saved on smelting. Let's look at the actual physical production that they are putting through this newly optimized system. They produced 17,315 tons of copper in the second quarter.
We really need to break that down by operation to understand the efficiency profile. The Caraiba complex produced 8,351 tons, while the Tucuma operation produced 8,964 tons.
And as we just discussed, the tonnage only matters if the cost to produce it makes sense. The industry standard metric for this is the C1 cash cost.
Yeah, let's define the C1 cash cost, because it's the baseline metric of mining viability.
What does it include?
It measures the direct fundamental cost required to mine the ore, process it through the plant, and deliver the concentrate, minus any byproduct credits. It doesn't include corporate overhead, exploration, or capital expenditures. It is the pure cost of making the product.
Got it. So for the consolidated operations, their C1 cash cost was $2.42 per pound of copper.
Which is incredibly competitive in today's environment, but the variance between the two sites is very telling. Caraiba operated at a C1 cost of $2.76 per pound.
Okay.
Tucuma, however, ran substantially leaner. They came in at just $2.10 per pound.
Why is Tucuma so much cheaper to run?
It comes down to throughput efficiency. Management noted that at Tucuma, the plant throughput, so the sheer volume of rock they are successfully pushing through the processing facility, increased by an astonishing 27% quarter over quarter.
Wow.
They crushed and processed over 715,000 tons of material in just 3 months.
Wait, help me visualize that. 715,000 tons. What does that actually look like in the physical world?
Well, imagine a standard heavy haul mining truck, right? The massive ones with tires twice the height of a person.
Yeah, the monsters.
They generally hold about 300 tons of rock. To move 715,000 tons, you are talking about nearly 2,400 of those massive trucks, fully loaded, dumping rock into the primary crushers over a 90-day period.
That's insane.
It is an unrelenting, continuous flow of material. And the more tons you can push through the fixed infrastructure of the plant, the lower your per unit cost becomes.
Oh, because those fixed costs like the power grid, the salaries of the plant operators, they're spread over a larger volume of finished copper.
Exactly.
So Tucuma's running like a highly tuned engine. But while copper is the namesake and the foundation of Ero Copper, we have to talk about the gold.
We definitely do.
Because the gold narrative in this Q2 report is where this story goes from being a solid industrial analysis to an absolutely fascinating case study in problem solving. Total gold production hit 20,553 ounces. And specifically, at their Xavantina operation, gold production spiked by 170% quarter over quarter.
170% sequential increase is an extreme statistical outlier.
Yeah, you don't see that every day.
Not at all. When you see a jump of that magnitude, you really must dissect the origin of those ounces.
Yeah.
You cannot just assume they found a richer vein of gold underground.
And they didn't. Out of the roughly 20,500 ounces they produced, only 8,693 ounces came from actively mined gold, meaning rock they recently blasted and hauled out of the earth.
And we should note that the C1 cash cost for that actively mined gold was $1,586 per ounce.
Which is pretty standard, right?
Yeah, and that's actually a 25% improvement from the first quarter, driven by higher mining rates and better grades. But it still requires massive effort and capital to extract.
Right. But here's the mechanism that should have every investor leaning in. The remaining 11,860 ounces. The absolute bulk of the gold produced did not come from fresh mining.
Yep.
They were recovered from what management called historic concentrates. And the C1 cash cost for those recovered ounces was a jaw-dropping $633 per ounce.
You really have to look at the margin there. Gold is currently trading well over $2,000 an ounce. They are producing nearly 12,000 ounces at a direct cash cost of $633.
The margin is spectacular.
It really is. But the real analytical question is, why is the cost so low, and where did this historic concentrate come from?
This is exactly what I was digging into, and it is my absolute favorite detail of the entire earnings call.
It's a great story.
The cost is low because all the expensive heavy lifting, the drilling, the blasting, the loading of the trucks, the initial crushing was already done months or years ago.
Yeah.
That is sunk cost.
It was already paid for.
Material was just sitting there on the surface.
Yeah.
So why wasn't it processed and sold immediately? Why let thousands of ounces of gold just sit in the dirt?
It came down to a battle against physical chemistry and the Brazilian weather.
Exactly. Water. The historic concentrate was essentially a lake of valuable mud. During the intense Brazilian rainy seasons, this material became hypersaturated.
And mud is a nightmare for a plant.
Right. When you try to run wet, sticky mud through a processing plant, it clogs the filters, it jams the conveyors, and it grinds the entire operation to a halt. It was literally too wet to sell.
For a lot of mining management teams, this is where they just throw their hands up.
Yep.
They blame the weather on the earnings call. They classify the wet concentrate as inventory, leave it on the balance sheet, and tell investors, well, we will process it when the sun comes out.
But the OneEro culture we talked about earlier, that obsession with efficiency, prevented them from just accepting the weather as an excuse. So what is the mechanical solution to wet dirt? You try it.
It sounds so simple.
Management identified the bottleneck, and they didn't overcomplicate the engineering. They went out and procured a new mobile filter press and a massive industrial dryer.
Let's break down the mechanics of that, because it isn't just a giant hairdryer.
Right, it's serious industrial equipment.
A mobile filter press is a piece of heavy machinery that uses hydraulic pressure to physically squeeze the water out of the mud. It separates the liquid from the solid particulate. Then, that dewatered cake is fed into the industrial dryer, which uses thermal energy to evaporate the remaining moisture until the concentrate hits the exact moisture specifications required by the smelters.
It is the most unsexy, unglamorous investment imaginable. It has absolutely none of the romance of discovering a glittering new gold vein deep underground.
Not at all.
But by deploying targeted capital to buy a giant machine that simply squeezes and bakes mud, they unlocked almost 12,000 ounces of gold at a $633 cost.
It is a profound example of operational debottlenecking. They looked at an asset trapped on their balance sheet, identified the specific physical barrier preventing its monetization, which was moisture, and engineered a direct mechanical solution.
And the cash flow implications are massive. CEO DeFilico pointed out that even when you factor in the all-in sustaining costs, the AISC, which includes the C1 costs, plus the ongoing capital required to maintain the line, they're generating a $700 AISC on those ounces.
That's incredible.
In a market where gold is selling for record highs, the cash generation is phenomenal.
This industrial dryer perfectly encapsulates the thesis of our analysis today. A mining company is essentially a collection of controllable and uncontrollable variables.
Right.
Management cannot control the global price of copper. They cannot dictate the spot price of gold. They cannot control the inflation rate or the Brazilian rainy season.
But they absolutely can control how fast they dry their gold concentrate. They can control how fiercely they consolidate their supply chains through OneEro. They can control their posture at the negotiation table with the smelters.
Exactly. And we see this relentless focus on controllable throughput across the entire portfolio. Look back at the Caraiba operations.
Okay, what's happening there?
Well, while Tucuma had the spotlight for low costs, the plant at Caraiba quietly processed over 1.07 million tons of material in the quarter. They are currently on track to set a new annual throughput record for 2026.
And they are applying the exact same debottlenecking philosophy back at Tucuma. Management announced they just completed the first phase of a tailings filtration expansion. Let's translate this for a second. What are tailings, and why does filtering them matter to the bottom line?
Tailings are the waste product of the mining process. Once you've crushed the rock and extracted the valuable copper concentrate, you're left with a massive slurry of finely ground rock and water.
Just a huge mess.
Yeah. Historically, mines would just pump this wet slurry into a massive holding pond called a tailings dam.
Which we know can be incredibly dangerous.
Yes, due to environmental regulations and the catastrophic risk of dam failures, the modern industry standard is dry stack tailings. You have to press the water out of the waste rock before you stack it.
Which means the speed at which you can squeeze the water out of your waste directly dictates how fast you can process fresh rock at the front of the plant. If your tailings filters are full, the whole plant has to slow down.
Precisely. The tailings filtration circuit was the choking point at Tucuma, so management intervened. They didn't build a whole new plant, they performed a surgical upgrade.
What did they do?
They added additional filtration plates to their 3 existing filters. By simply increasing the surface area for water extraction, they yielded an immediate 8% improvement in total capacity.
And they aren't stopping there. They have 3 entirely new modular filters arriving in the third quarter, which will be commissioned and running by the fourth quarter.
It is a continuous loop of identifying the restriction, applying mechanical fix, and increasing the overall flow of cash through the system.
So if we synthesize everything we've looked at so far, the 49% jump in cash flow, the deleveraging of the balance sheet down to 0.8x, the massive margins on the gold, none of it was accidental.
Not at all.
It was the result of a management team running a fine-tooth comb over the physics and logistics of their operations, from supply contracts to tailings plates and engineering solutions to maximize leverage.
They're doing the hard work.
But Wall Street, as we know, is completely ruthless.
Yeah.
It does not pay a premium for yesterday's success. It only cares about the future trajectory.
Which brings us to the forward-looking statements. We have established that Q2 was a structural victory. The critical question now is, what is management promising for the rest of 2026? And can they actually maintain this leaner, more profitable profile?
Let's dissect their production outlook first. They have maintained their consolidated copper guidance for the full year at 67,500 to 77,500 tons.
That provides some nice stability.
It does. But more importantly, Chief Operating Officer Gelson Batista noted they expect stronger operational performance in the second half of the year.
We need to look at the geological mechanics of why they expect that stronger performance. Batista pointed to 2 specific drivers.
Okay, what's the first one?
First, they expect to access higher grade benches at their Surubim open pit.
Open pit. So that's the massive terrace amphitheater style mine.
Right. As you dig deeper into the pit, you access different benches or layers of rock. They are projecting that the benches they will reach in Q3 and Q4 simply contain a higher concentration of copper.
And higher grade means more copper per ton of rock moved, which mathematically lowers the C1 cost.
Exactly.
And the second driver?
The second driver is at their Pilar underground mine, where they anticipate higher grades in tonnage due to planned stope sequencing.
Let's make sure we clearly define a stope for our listeners. When you are mining underground, you aren't just digging a single endless tunnel.
No, it's much more complex.
You drive a tunnel into the ore body, and then you drill and blast out massive vertical or horizontal caverns to extract the valuable rock. Those blasted out caverns are called scopes. So stope sequencing just means they have carefully mapped out the underground geology, and the schedule dictates they are moving into the richest, most easily accessible caverns in the back half of the year.
That is correct. They are sequencing the high-grade extraction to align with their optimized plant capacity.
Makes sense.
Now, on the gold side, the guidance is slightly more nuanced. They are maintaining their full-year guidance of 40,000 to 50,000 ounces of mined gold. However, management was highly transparent in managing expectations, stating they expect the final result to land at the low end of that range.
Which is fair, because they had a slower start to the year at the Xavantina underground operations before they deployed the mobile filters and the dryer.
Yeah, that ramp-up takes time.
But they still expect about 65% of their full-year mined gold production to hit in the second half of the year. And as that production scales up, the fixed costs are distributed over more ounces, so unit costs are expected to decline.
Right.
They updated their Xavantina cash cost guidance to $1,100 to $1,350 per ounce for C1 and $2,200 to $2,700 per ounce for all-in sustaining costs.
While the production guidance is stable and logical, we must scrutinize the capital allocation guidance. This is where the risk profile changes. Management announced an increase in their capital expenditure guidance. The CapEx range was bumped up by $10 million, bringing the new projected spend to $285 million to $330 million for the year.
Okay, stop the tape. I am putting my retail investor hat firmly on my head right now, and I am pushing back hard on that.
I knew you would.
We have just spent 30 minutes praising this management team for their ruthless financial discipline. They slashed debt, they squeezed $15 million out of their suppliers, they negotiated $20 million out of the smelters, and now, in the very same earnings call, they announced they are hiking their CapEx spending by an extra $10 million.
Specifically for a new power line at the Xavantina site.
Plus, the CFO, Wayne Dreyer, issued a warning about currency fluctuations driving up unit costs. Look, I've seen this movie before. A miner gets a massive cash infusion, the discipline vanishes, and suddenly they are funding pet projects and vanity infrastructure. Why shouldn't I view this $10 million power line as classic corporate cost bloat?
It is the exact right reflex to have. Whenever CapEx increases, especially during a quarter of high cash flow, you must assume cost bloat until proven otherwise. You have to demand the ROI, the return on investment.
Right.
Let's isolate the $10 million power line and examine the mechanics of power generation in remote mining.
Please do, because $10 million buys a lot of electricity.
In remote regions of Brazil, mining operations often cannot rely on a stable, high-capacity national grid. To keep the processing plants and underground ventilation running 24/7, they frequently have to supplement their power with massive on-site diesel generators.
Let me guess. Diesel is not cheap.
Diesel is expensive to buy, it's expensive to transport over hundreds of miles of dirt roads, and it's highly carbon intensive.
So they are currently burning cash to burn diesel.
Yes. What this $10 million CapEx bump represents is the construction of a dedicated high-voltage transmission line to directly connect the Xavantina site to a more reliable, vastly cheaper grid power source. Management explicitly stated that they expect this specific $10 million investment to literally pay for itself within 2 years through the direct elimination of those ongoing exorbitant diesel and inefficient local power costs.
A 2-year payback period.
Yes. After month 24, that $10 million is recouped, and the ongoing structural cost of operating the Xavantina mine drops permanently.
Okay.
It isn't vanity infrastructure. It is a surgical capital strike designed to permanently lower the all-in sustaining cost profile. It also strengthens the site infrastructure to handle future plant expansions. It is short-term capital pain for long-term, highly visible margin gain.
I see why you defend the power line. A 2-year ROI on infrastructure is undeniably good business, but you cannot wave away the currency warning quite so easily.
It's a different issue, yes.
CFO Wayne Dreyer was explicit on the call. He warned that a stronger Brazilian real, the local currency combined with local inflation, could add 10 cents per pound to their reported copper C1 cash costs and up to $100 per ounce to their mined gold costs. He also flagged that it could artificially inflate their reported capital expenditures by $20 to $25 million. That is a massive leak in the boat. How do you defend that?
Well, if you only read the headline risk, it sounds terrifying. But this is where we have to look past the accounting surface and analyze the financial engineering. The brilliant mechanics of this management team are fully on display here.
Okay, lay it on me.
We need to do a deep dive into their foreign exchange hedge program.
Let's unpack it, because currency risk destroys mining companies operating in emerging markets all the time.
It really does. Let's map out the structural vulnerability. Ero Copper is a global commodity producer. The global markets price copper and gold exclusively in US dollars. So every time Ero sells a shipment of concentrate, they receive US dollars. However, their mines are physically located in Brazil. They pay their miners, they buy their local supplies, and they pay their domestic taxes in Brazilian reals.
Right. So there is a constant, unavoidable currency conversion happening in the background of their operations.
Exactly. If the Brazilian real suddenly gets stronger relative to the US dollar, it requires more US dollars to purchase the exact same amount of local Brazilian reals.
Meaning their costs go up.
So even if the mine operates with perfect efficiency and they use the exact same amount of labor and fuel, their operating costs when reported back to Wall Street in US dollars, will suddenly look significantly higher.
Their buying power simply evaporates.
Yes. To protect the company's cash flow against this uncontrollable macroeconomic variable, Ero's Treasury Department essentially bought an insurance policy.
An insurance policy against the currency.
They purchased financial derivative instruments, currency hedges, designed to trigger if the Brazilian real strengthened past a certain point.
It's like locking in a fixed-rate mortgage just before the central bank hikes interest rates. You are paying a premium to guarantee that no matter how crazy the variable rates get, your monthly payment is protected.
That is a perfect analogy. Management designed this hedge program to explicitly protect approximately 70% of their consolidated full-year operating and capital costs. They set the protective floor at an average exchange rate of 5.54 Brazilian reals per US dollar.
So mechanically, even if the actual real-world exchange rate drops to 5.0 or 4.80, meaning the real is incredibly strong and expensive, Ero Copper's costs for 70% of their budget are mathematically locked in at that safe 5.54 rate.
Precisely. And this is the critical part that trips up retail investors and algorithms that simply scan the press release.
Yeah, why is that?
Because of strict corporate accounting rules, the reported C1 cash costs are not allowed to include the financial gains from this hedge program. The hedges are kept strictly below the line on the income statement.
I see where this is going. So when Wayne Dyer warns that C1 costs are going up by 10 cents a pound, that is just the raw, unhedged accounting metric. It looks terrible on paper.
It looks inflated,
Yeah.
but the physical reality of the bank account is completely different. The insurance policy triggered. In the second quarter alone, as the Brazilian real strengthened, Ero Copper realized $12.7 million in actual cash gains from their foreign exchange hedge program.
Just in one quarter.
Right. And for the first half of the year, those hedge gains totaled $20 million.
So the accounting rules force them to show higher costs on line item A, but line item B is quietly pumping tens of millions of dollars in cash directly back into the company.
Exactly. And assuming an exchange rate of roughly 5.9 through the end of the year, management expects the hedge book to generate an additional $20 to $25 million in realized cash gains.
We are talking about $40 to $45 million in pure cash coming back to the Treasury entirely from this currency insurance policy for the full year.
Wayne Dyer made it crystal clear to the analysts on the call. While the stronger local currency makes the local costs look higher on the reported unit metrics, the actual impact to the company's cash balance is practically wiped out. It is substantially offset by these realized derivative gains.
The risk is completely neutralized.
It is a masterclass in corporate treasury management. They anticipated the macroeconomic risk, they bought the precise instrument to insure against it, and the instrument paid out exactly as designed to protect the cash flow.
That is wild. So an algorithm scraping the C1 cost data might trigger a sell-off because costs look bloated. But a human analyst who reads the actual cash flow statements sees the $45 million cash injection acting as a perfect shield.
This is exactly why you have to look under the hood of the accounting.
You have to follow the cash. Okay, speaking of massive capital projects that require following the cash, we have to talk about the Pilar shaft at the Caraiba operations.
Oh, this is a big one.
This was a major point of discussion during the Q&A segment of the call. Orest Waukedaw from Scotiabank and Rafael Barquilos from Bradesco were both aggressively questioning management about it. Ero is currently sinking a massive vertical shaft 1,100 meters below the surface. What is the current status of this, and why is this single project so critical to the company's future?
Let's establish the status first. Management confirmed they have successfully passed the 1,100-meter mark in depth. The sinking rates, the speed at which they are excavating downward, are improving because they have just connected the third leg of the project infrastructure.
So it's speeding up.
Yes. They expect to reach the absolute bottom of the shaft by the end of this year.
And then it's finished.
Not quite. You don't just dig a hole and start using it. They will use the entirety of 2027 to transition from the active sinking phase into the operational equipping phase.
What does that involve?
Installing the hoists, the cages, the electrical systems. The first full year of operational benefits will hit the balance sheet in 2028. The budget for this year alone is around $80 to $90 million, and they are about halfway through that spend.
That is a staggering amount of capital and time. CEO Dave Filippo made a very poignant historical comment about this. He pointed out that the last major shaft built at the Pilar mine was completed in 1986.
Wow.
Ero started the engineering and design for this new shaft way back in 2020. This is not an investment designed to juice the next quarter's earnings. This is a foundational investment meant to secure the operations for the next several decades.
And sinking a shaft 1,100 meters into the earth is incredibly complex and dangerous work. De Filippo was explicit on the call regarding station.
Wait, what do you say?
They are utilizing specialized third-party contractors brought in from South Africa, which has a long history of ultra-deep shaft sinking. He stated unequivocally that if they encounter difficult ground conditions and need to slow the project down by a month or two to ensure the safety of that crew, they will make the call to slow down 10 times out of 10.
Which is exactly the kind of disciplined, safety-first rhetoric you want to hear from a CEO managing a high-risk underground engineering project.
Absolutely.
But let's look at the ROI. Why spend hundreds of millions of dollars and almost a decade of planning just to build an elevator? De Filippo painted a vivid, almost painful picture of the current logistics.
He did. To understand the value of the shaft, you have to understand the nightmare of the current commute. Right now, to access the deepest, richest parts of the Pilar mine, the workforce has to drive down a spiraling underground decline ramp.
Okay, picture that.
De Filippo noted that it can take up to an hour and a half of driving in the dark just to reach the active working phase.
I want the listener to really internalize this. A 90-minute commute down a dark, steep, winding tunnel just to get to your desk. And underground mines in Brazil are heavily regulated. They operate on strict 6-hour labor shifts.
Let's do the math on that inefficiency. If a miner's legal shift is 6 hours, and it takes an hour and a half to drive down the ramp.
And presumably an hour and a half to drive back up the ramp at the end of the day.
You are losing 3 full hours of every shift to transit. You have a 50% availability of your workforce in the absolute highest grade zones of the mine. Half of your massive labor cost is literally being spent on employees sitting in vehicles, commuting in the dark.
That is a staggering logistical bottleneck. It is bleeding capital.
It is. But when this new 1,100-meter vertical shaft is fully operational in 2028, it completely bypasses the spiral ramp.
Because they can just drop straight down.
It is designed to act as an industrial express elevator, capable of getting the entire workforce safely in and out of the deep mine in under an hour total.
The productivity gains there are astronomical. You are essentially doubling the productive time of your workforce at the deepest levels without hiring a single new employee. Plus, a vertical shaft dramatically improves the ventilation, pushing fresh air down to the bottom much faster, which cools the mine and improves equipment performance.
It transforms the fundamental economics of the Pilar mine. It is the exact same philosophy as the industrial dryer at Xavantina, just applied on a massive multi-decade, $100 million scale. Identify the physical bottleneck, in this case, human transit time, and build a permanent structural solution to eliminate it entirely.
So we have thoroughly examined the landscape. We've seen the cash inflection numbers. We've explored the operational wizardry of dryers and data analytics. We've analyzed the CapEx investments, and we've proven how the FX currency risks are heavily mitigated by brilliant hedging.
We've covered a lot of ground.
This brings us to the final phase of our analysis, the bottom line. What does all this data mean for you, the retail investor looking at your portfolio right now?
It means we have to take a clear, opinionated stance based on the mechanics we've just outlined. And the data signals overwhelmingly that this Q2 report is a strongly, undeniably bullish indicator for Ero Copper.
I agree. You look at the moving pieces and they're all sliding into the right slots.
This is a management team executing flawlessly on the strategic promises they made at the start of 2025. The cash inflection we debated earlier is real.
It's here.
It isn't a projection. It is actively happening on the balance sheet right now. By permanently de-risking their debt and fundamentally lowering their operational choke points, they are structurally more profitable today than they were a year ago, regardless of where the commodity cycle goes next.
Okay, but bullish is an adjective. Let's give our listeners an action. What is the specific actionable takeaway? What should an investor holding ERO or considering opening a position in ERO actually do with this information?
We need a trigger.
Exactly. We're going to outline the exact trigger you need to monitor. And it all comes down to tracking one specific number, the revolving credit facility.
During the Q&A, Guilherme Rizito from Bank of America and Emerson Vieira from Goldman Sachs both aggressively pushed management on capital allocation.
They wanted to know where the money's going.
The underlying tone of their questions was clear. You are generating $138 million in operating cash flow. You are printing money. When do the shareholders get a cut of this cash?
And CEO Marco DeFilippo essentially drew a treasure map for the analysts. He laid out a rigid, unyielding three-step process for capital allocation.
Step 1.
Step 1. Get the net debt leverage ratio below 1.0x to ensure the survival and resilience of the company.
Which, as we noted, they achieved in Q1, and at 0.8x today, they are firmly past that milestone. Step 1 is complete.
Step 2. Pay off the revolving credit facility completely. Ero Copper has paid off $60 million of this facility so far this year through July. They currently have exactly $95 million they have to pay down on that revolver.
And once step 2 is complete, they reach step 3, direct shareholder returns.
The payoff.
Whether that manifests as a formal recurring dividend policy or aggressive stock buybacks, that is the prize waiting at the end of the maze.
This is your actionable takeaway. If you are holding ERO, you are watching that $95 million debt ticker like a hawk. The moment that specific balance hits zero, management is heavily hinting at a massive payday for shareholders.
They were very clear.
DeFilippo explicitly stated they want to see that exact pace of debt reduction continue. And once they officially achieve that second milestone, they will provide the market with absolute clarity on the shareholder return program.
It creates a highly visible timeline for investors. Assuming commodity prices remain relatively stable and their second half production scales exactly as they have guided with the richer stopes at Pilar, that $95 million balance is going to evaporate rapidly.
So it's coming soon?
It is no longer a matter of if the company will return capital, but when.
And while they are aggressively clearing the decks of this debt to prepare for a dividend, they are simultaneously planting the seeds for their next massive phase of corporate growth. Because a mining company that isn't looking for new rock is a dying company.
True.
Let's talk about the Furnace project.
The Furnace project is a critical piece of the long-term valuation puzzle. This is an exploration project that is rapidly advancing toward becoming a core foundational asset for Ero Copper.
What's the latest update on it?
During the call, management noted that their Phase 3 drill program is currently underway. This is a massive 45,000-meter drilling campaign, and they are already more than 31,000 meters complete.
Help us visualize this scale of that. What does a 45,000-meter drill program actually mean logistically?
45,000 meters is roughly 28 miles of solid rock core pulled out of the earth.
28 miles.
Yes. It requires multiple diamond drill rigs operating around the clock, pulling up cylindrical samples of rock from deep underground. Geologists then painstakingly log, cut, and chemically assay every single meter of that core to map out the exact three-dimensional shape, size, and grade of the underground copper deposit.
That sounds exhausting.
It is a massive undertaking of capital and scientific manpower.
And they are moving at breakneck speed. They are on schedule to finish this entire 28-mile drill program before the end of the year.
The velocity is what's truly fascinating here. DeFilippo proudly pointed out that they are effectively completing what would normally be a 5-year exploration drill program in the better part of 2 years.
Wow.
Based on this speed, they expect to publish a pre-feasibility study, often called a PFS, in 2027.
A pre-feasibility study is exactly what it sounds like. It is the rigorous, comprehensive engineering and economic model you build to prove that the copper deposit you just mapped can actually be mined profitably. It's the critical stepping stone right before you make the final multi-million-dollar decision to actually build a new mine.
And the early assay results they are seeing at Furnace are stellar. The June project update demonstrated continued high-grade continuity.
Meaning they keep finding good rock.
Right. They are finding that the copper mineralization extends both deeper into the earth and further along the strike length than previously known. This is no longer just a geological science experiment. Furnace is looking increasingly like Ero Copper's next major leg of operational growth for the 2030s.
Which brings us to the ultimate strategic question hovering over this entire company. Let's zoom out as we wrap up this deep dive. I want you to look at the entire board we just laid out.
The macro view is very compelling.
We have a company generating massive, structurally protected cash flow. They are aggressively hacking their debt down to zero, unlocking near-term shareholder returns.
Check.
They're actively dropping their unit costs by surgically deploying capital, buying industrial dryers, upgrading filtration plates, and sinking massive new transit shafts. They are actively and successfully neutralizing their local currency risks with brilliant hedge programs. And they are sitting on a massive, highly successful 45,000-meter drilling phase for their future furnace mega project.
By all operational metrics, Ero Copper is a perfectly optimized, finely tuned machine right now.
Right. Now, drop that optimized machine into the current macroeconomic landscape. We are in an industry where the major multi-billion-dollar mega miners are desperately hunting for cheap, high-quality, de-risked copper assets to fuel the global green energy transition.
Oh, absolutely. The big guys are hungry.
The world needs millions of tons of copper for electric vehicles and grid upgrades, and the big players just do not have enough mines to supply it. Rafael Barcelos from Bradesco actually brought this exact tension up during the Q&A, directly asking how Ero sees itself fitting into the recent M&A trend in the copper sector.
And DeFilippo gave the perfect, diplomatically sound CEO non-answer.
Of course he did.
He acknowledged that they have a corporate development team that constantly evaluates opportunities in the Americas, but insisted they are entirely focused on executing their own internal portfolio because they believe Furnace is one of the best development projects in the entire market.
It's the polite corporate way of saying, we know exactly how valuable we are, and we aren't selling cheap.
Exactly. Make us an offer we can't refuse.
But I want to leave you, the listener, with this final provocative thought to mull over as you review your portfolio. Think about the mechanics we discussed today. With a balance sheet getting this breathtakingly clean and operations running this astonishingly lean, is Ero Copper destined to reap these massive cash rewards as an independent powerhouse for decades to come?
That's the dream scenario for a long-term hold.
Or, by fixing all their legacy problems, buying the unsexy industrial dryers, eliminating the debt, and perfectly de-risking their cash flows, did they just make themselves the absolute perfect turnkey acquisition target for a much bigger predator?
That is the multi-billion-dollar question. When management clears the murky waters of operational inefficiency, they make it very, very easy for a much larger fish to see the prize sitting on the bottom.
We started this deep dive looking for precision. We were looking for the clear, visible signal through the noise of corporate jargon. Well, Ero Copper just provided it in spades. No excuses about the rainy season. Just cold, hard, mechanical cash inflection. Stay informed, keep watching that $95 million revolver like a hawk, and keep dissecting the data. We will catch you on the next Talk Tickers Deep Dive.